Welcome back to Fledge. Today we're going to be talking about financials. And so as we go down the chart, we talked about opportunity size and competition before, and the next piece down is financials. In terms of the entire business plan, there's kind of three pieces to it. Right? People talk about the business plan as if it's one big thing. It's not one big thing. There's three pieces that you need to work on. One is the pitch. So what do you say when you stand up in front of investors? Again, it's useful for recruiting and banks and whatnot as well. Two is what's the plan? And often, traditionally, that's a paper plan, 20 or 30 or 40 or 50 pages long. We don't see them too often these days, but they're still out there, at least the executive summary. And the third piece is you're expected to have a financial model to answer the questions about the finances of the business. And those three pieces are actually the whole business plan. So if you're missing one of those, you're not actually in terms of the financial plan itself, it exists to answer a few questions. First and foremost, can this business make any money? And if so, when will it make the money? And what are you going to need in order to get there? So you can put together any plan you want. You can say it's going to be a $1 billion business, but it may take $3 billion to get there. Or you can say it'll be a $1 million business, and it may take $2 billion to get there. You may say it's a $100,000 business, and it may take $2 to get there. So the financial plan answers that question. How much money, how many people, what else do you need? Now, usually people freak out, they jump into Excel, they start making highly complicated spreadsheets. That is a horrible path to try and follow. What you should start with is what I call the back of the envelope calculation. So what you do is you just look out into the future, quote, at scale. We don't really know what year that is, but you don't have to figure out what year that is. But just think of some year out of it after you've got up and running. And do an estimate. That year, I think we're going to sell $1 million worth of product. It's going to cost us $300,000 to do that. And in order to sell $1 million, here's what I estimate the expenses to be. And if you look out here, you can see kind of some pieces that explain why those numbers got picked. Right, back of the envelope numbers, big chunky numbers. And if the number at the bottom is positive, then you potentially have something. If it's negative, well, then you hit yourself a little roadblock, and you need to go back and figure out how to make the number positive. And then the question is, how on earth do you get to scale? Right? So step two is to then expand that into more columns. Right? Columns are time, rows are information. Right? So you're going to add in years 1 through n. And in this process, you can figure out what year you're actually looking at. Right? And so there's some just rough guidelines. You're not going to grow 5 times per year. Right? That would be an excessively high growth company. You're not going to grow your revenues or your customer base 5 times in 1 year. Right? 3 would be a venture scale company. Be able to grow 3 times for 3 years or 4 years. At a reasonable starting spot.
Can I just clarify, when you say venture scale, are you specifically referring to a high-tech growth company? Or?
They're venture capitalists, do invest in other things besides software. But they look for what they call venture scale companies. And a venture scale company is one that grows 3 times per year every year, for 3 or 4 years, until it hits the $1 billion mark and it gets sold. Anything smaller than that, and they look at it and they go, well, that's not venture scale, I don't care. Right? So if you have a plan and you're growing 10 times, you're going to start with 1,000 customers and then you got 10,000 customers. People like me are going to look at that and go, it's not realistic, it's not going to happen. There's a missing year or 2 in there. Right? So you can work your way backwards. So if this was your back of the envelope calculation, and now it's broken out into more detail. We'll talk about that. If it was 100,000 in this year, and you're not going to break this 5x, great, let's drop it down, in this case, by 5. And that could be year 2, and then we'll drop it down again by 5 to year 1. And well, that tells me if I think I can do 4,000 sales in year 1, then that was year 3. And if this feels ridiculously high, and it looks a little bit high, and I drop it down to 3, well, that 100,000 was actually year 6. Right, so I can use these kind of gross areas to see what the growth should be and see how many years it takes to get there. And then once I have these numbers up here, I can kind of estimate, again, back of the envelope, big chunky numbers, what would be the expenses to sell that many. And you can see here, you're going to lose money for 2 years, and then you're going to make money. And if we had to expand this to 6 years, and you lost money for 4 years before you made money, that's a yellow flag. Hey, this is a very tough business to get going. If this works, if you can make a back of the envelope, nice, simple, one-sheet financial plan, and it looks reasonable, then you can continue and make a full-on financial plan. If it has these yellow flags around, oh, we're going to lose money for 10 years. Oh, we just need to throw $5 million into this plan to go make 100,000. Things like that. Well, then you need to go back and look at the business model. Right? The business model of how you're going to make money. All right, once you're ready to go forward, it's time to make a full financial plan. And a full financial plan is a clear, logical, believable story. And this is where a lot of the breakdown happens. I see a lot of plans, they all look different. Most of them are not stories. Right? And that's the key piece on the top here. So clear means it's understandable, right? Logical means there are no gaps. You can walk through it step by step and understand each step. Believable means all the numbers in there seem reasonable to anyone who understands that business. And the most important one is on the bottom, which is that it tells a story. Right? Just like your pitch tells a story, your financials tell a story. Right? And I'm saying this over and over again because it's that important. And here's how you do it. You start with a unit. So what is the unit of production for your business? And depending on your business, it has a different unit. Right? So in automotive manufacturing, they build big cars. Right? They're not selling tires separate from engines, separate from bodies. You buy the whole car. It comes with all these pieces in it. Right? All the way to Google, the fundamental unit of Google is the search. Not the ad, not the search entry, the page that is the search results, right? Which is generated by someone typing in a keyword and doing a search. At a grocery store, it's not a product, it's the whole shopping cart. Right? So if you're building a grocery store business, your fundamental unit that you need to worry about is how much stuff in dollars and units is sitting in that shopping cart. Same thing for an online store, like Amazon. In the airline industry, it used to be the round-trip flight. It's becoming more and more the single-direction flight, one unit. Those are add-on costs, but the airline industry is all wrapped around, at least point-to-point flights. Not how many hops you had in between, but source and destination. In a magazine business, it's the whole year subscription. You want an annual subscription, same thing with newspapers. Right? Same thing with a lot of online software. It's the annual subscription, not the individual usage, not how many times they read the magazine, not how many units, not how many individual pieces they got. On eBay, it's auctions. Right? So every business is a little bit different. You have to find out what your unit is. Second, you got to find out what does it take in terms of cost to make that unit. It's called cost of sales. People get confused between, we talk about variable expenses and fixed expenses. Once you know what your unit is, it's rather simple to say, I know it will cost X dollars in order to make that unit happen. So again, we go back through these, but to build that car, you have parts and labor to build the car. Right? To build the Google search, they really don't have any costs per search. Right? There's a marketing cost that's a fixed cost. The actual cost of them to deliver that search is so negligible, it's not worth counting in here. Right? All the way through, right, the magazine side was writing and printing and so forth. All right, so what are you expecting your customers to buy? How many of those units are the customers buying when they sit down and buy? What's the average sale price per unit, and what is the average number of units? So again, we can go back through here. Usually when you buy cars, it's one car, but if we're doing airlines and it's point-to-point, the normal number would be 2. And probably if you took their average, it would be 2.3, because some people do these triangles. And each one has a different amount of money attached to it, so these Z's here are just showing, sometimes it's single dollars, hundreds of dollars, thousands of dollars, and so forth. So let's walk through an actual example of this, which would be your ubiquitous lemonade stand. Right? And if you haven't seen it, if you don't know anything about business finances, there's a really good book called The Accounting Game that will teach you how to do traditional accounting, rural accounting, based on the lemonade stand. Just to be clear, we're not doing traditional accounting. The result of this financial plan, the output, is not a P&L, it is not a cash flow statement, it is not a balance sheet. It is none of those, it is something else that I simply call a financial plan. Right? Other people call it pro forma, which just means we put this together for the purpose of showing you our finances. But it doesn't really have a good name. Right? It's not your standard accounting. All right, so lemonade stand. We have unit is glasses. Right. So the fundamental unit is a cup of lemonade, and the cost of sales in my model has a glass. We have lemons, sugar, water, and label. So when you do out the back of the envelope, all right, we've got a lemonade stand. We're going to sell 100 glasses in a day. This is going to be a giant lemonade stand. At $1 a glass, it's $100. Here are some costs that go into making that cup. So it's 60 cents to make that $1 glass. So it's $60 to do the 100, which leaves a gross profit at the bottom of $40. So when we talk about the top line revenue here is 100, after cost of goods, it's 40. Lots of stories back in the dot-com era that their cost of goods were higher than their sale price, and they were going to make it up on volume. That won't work. All right, and I'm going to dive into the full-on financial plan of this in a moment, but a few more tidbits before we do that. One, I hear this from everyone, including myself, my younger self. Every one of these numbers in your financial plan is made up. And so a lot of entrepreneurs get fed up. They're looking at these numbers over and over again, and they're going, but it's not real. Everything is just a guess. And the answer is yes. It's true. Every number is just a guess, but you are going to put so much thought into this that they're the best guesses ever made of that business plan. And yes, it's wrong. We know it's wrong, but it's still the best guess possible. You need to separate your assumptions from everything else. So your financial plan is a set of assumptions and then a set of calculations. In order to help people figure out what's an assumption and what's not, my suggestion is that every assumption is in blue and everything that's computed is in black. Right? So when you look at a number in there and it says, $100,000 for whatever, if it's in blue, we know it's a number that was made up. Somebody made that guess. Whereas if it says $100,000, it's in black, we know it's based on some assumptions elsewhere. Second, there's no numbers hiding in any formula. What we can't have is things like this. We can't have, here's 100 units, and the revenue is number of units times 0.5. Right? Because we'll never see the 0.5 lying around there. So what we need to do is to say, there's 100 units, it's 50 cents, that has to be visible. And the revenues are just these two things multiplied together. The only exception to this is that you can multiply or divide by 3 if you're doing quarters to months. And you can multiply by 12 if you're changing from months to years. Right? Or 365 if you're trying to get to the full year. Right? Things based on dates, you can put those in the formula. We don't need to see that. We know there's 365 days a year. Right? Everything else needs to be visible on the screen. Otherwise, you can't read the story. Once upon a time, they lived happily ever after. That doesn't work. There needs to be something in between. A few more things that drive me nuts. You gotta have commas. You can't read a whole page of numbers without commas. You gotta have dollar signs wherever there's money, or euros, or yen, or whatever. There's two ways to do it in Excel. There's the accounting way and the currency way. I like the currency way. I like to see that dollar sign right next to the number to know it's a dollar. Don't show pennies unless you have to show pennies. And don't show too much precision. Right? So trunk and round are your friends. Right? So especially when you summarize. In your spreadsheet, that's fine. If it does say you're selling $12,345 worth of stuff, that's fine. When you go back out to your presentation or your executive summary to talk about that, no, it's 12,000 or it's 12,300.
Thinking of the iTunes 99-cent model,
Yes.
do you think they ran it in cents or updated it in dollars?
If you need your price to be $1.99 or $12.99 or $14.99, that's fine. You show that with cents. And the next line down where it shows what your total sales are, no cents. Right? You just throw away all those pennies. Yeah, Excel will keep them there. You just don't want to see them. Right? You want to see dollars. You want to get a business. Right? If your business is so fine-tuned here that it matters how many cents you made in year 3, then you're in trouble. Right? It should be how many hundreds of thousands of dollars you're doing in year 3. All right. Start as simple as possible. These things can get totally out of hand. So start with that back of the envelope and grow it. And again, I'm going to show you this in a minute. Until it gets really complicated, then stop. Don't make it, don't make it so complicated that you won't know how to drive this again in 3 or 4 months when you go back to iterate on it. Because if you can't drive it, no one else will drive it. Because it does get crazy after a while. Right? They turn into total eye charts. As you're doing this, save a lot. So every time you make a major change, save as, put a new name on it. Some people just do dates, some people do revision numbers. I think I'm on version 14 of my financial plan, something like that. And then other things you can do, once you have a plan and you think it's good, right, everybody will say that that plan is conservative. That's nice. How conservative is it? So do a save as, or do a copy of it. Go back in there and change the assumptions wildly. Go say, well, what happens if I'm wrong and I'm only going to make half as much revenue? Go in there and just put a percentage revenue, put a percentage somewhere in there, and multiply your revenue by that, and see what happens to your assumptions and see what happens to your model if you set that at 50%. One of the things that the venture capitalists do is they do that in their head. So if you present them with a financial plan, they will look at it and go, okay, now when we drop revenues by half, now how much money do we need to make? Does it still work? And sometimes I'll have you do that in real time. So do it yourself. What happens if you're off on people? What happens if you need twice as many people? Right? Play around with it in different copies. Don't do it in the mainline copy because then you might get an assumption that gets stuck in. And then in order to make it readable, I use lots of tabs. So I have a summary tab. This is actually a simplified version of my Fledge plan. Summary tab, I like to graph things. Then the P&L or the modified P&L is in there. Assumptions are all in one place. Revenues and expenses are split out.
You like assumptions and such?
I like assumptions all in one spot, yeah, so you can just change the assumptions. And lastly, I personally like visualizations. I like graphs. When I've shown this to others, almost no other financial ones have any graphs in them. But I'm a highly visual person. I want to see what the revenue curve looks like. I want to see what the expense curve looks like. Because if the revenue curve takes off and the expense curve is totally flat, it's a red flag. Businesses don't run like that. Expenses and revenues run not parallel, but similar shapes. Hopefully the expense line is lower. Right? And you can see here, it's really simple. Expenses are higher than revenues until this point, and then they switch and it becomes a profitable business. Right? In this case, I did this in PowerPoint. This is the high model and this is the low model, so I have two separate spreadsheets, one saved called high, one saved called low. and I just plotted them together in PowerPoint. All right, any questions on that? All right, so we saw this in the back of the envelope. Number of glasses, dollars per glass, gross revenues. Here are all the pieces that are cost of sales. And then we have some expenses down here. And this is where it diverges from a P&L. So we have net profit and loss. That would be the normal end of the P&L. Then I'm going to add in a few lines. We're going to add in any dollars that came in via investments, any dollars that came in or went out as loans, and this number at the bottom is the most important number in a startup financial plan. How much cash is in the bank? Right? So we're going to keep a running total along the bottom of this spreadsheet of how much cash is in the bank in any given column. Right? Everything else in this column just sums straight down. The cash line is the sum of the last column and the net profit and loss plus this other stuff on the bottom. Right? So for example, here we have, fill it up with month one. We're going to sell 1,000 glasses of lemonade at $1 a piece. Here we're showing some pennies because these things are small. So it's 60 cents to make that, so it's $600 of cost of sales, which is net revenues of $400. Let's say we got to do some marketing, so that's $60 worth of marketing. Right, you can see here that's black because it's a sum of everything below it. So $10 to make a sign, $50 for flyers around the neighborhood. We need a table. I need operational costs. We need a spoon to mix the lemonade. Total expenses are $80. That gives us a net profit or loss of $320 in that month. Didn't need any money to do that. It's kind of flubbing it because the money came in afterwards, so where do we get the money for the table and whatnot? We'll just say we took that out of our pig bank. Right? So it's not an outside. So cash is sitting at 320. Now we can go to the next step, would be to add the next month. Right? Your financial plan is going to be 12 of these columns, one per month to start with for the first year. Right, so I say we can grow it to 1,200 cups the second month. Right, same price. I think if we can get to 1,200 cups, we can drop the cost of labor by a penny. Right, that's what I'm assuming here, which brings the cost of sales down to 59 cents. So it's $700 worth of lemonade.
Why do you say that?
It seems like a reasonable assumption that as we grow the number of cups, that the cost of labor is going to stay fixed. It's going to be an hourly rate. We're going to sell more in the same amount of time, so the cost per cup goes down. All right, so net revenues this month comes out to $492. And what do we need? Well, we don't need another sign. We already have. We spent that. We need more flyers. We don't need another table or another spoon. So expenses are down. All right, so the net comes out to $432. Still no money. Still no investment in it. We're good on cash. Just to be clear, cash is last month's cash plus net profit or loss plus investments plus any loan. All right, that gives us the money. All right, month 3, we got much bigger. Okay? New location, better, we got much better. And we dropped the price too. So I say, hey, let's drop the price here and go big. Right? We're the low-cost provider of lemonade stands. So 2,500 cups of lemonade, $1,800 worth of stuff, and I say we're doubling sales here, the same number of people making this lemonade. Now that way down to 55 cents. Well, in order to do that, one reason why I think we're going to get much bigger is we're going to buy a really good sign. Right? Professionally made sign, $100. $500 worth of flyers. Right? Bigger table. Can't sell this much lemonade with the same size table. And 2 more spoons so we can make lemonade faster. I'm just doing the guess model here. But yeah, you could sit here and have a separate spreadsheet elsewhere that said my unit of lemonade, I get so many hours in a day, it takes me so much time to make the lemonade and whatnot. I'm estimating it down. best guess. Right? So when we do this, we see that all this marketing expenses and whatnot means that the expenses for the month were higher than the income. It was $1,140 in expenses and only $500 in income. And we lost money for that month. Right? So we sold twice as much, more than twice as much lemonade, but we lost $640 doing it. Right? But some of that's investment, right? We got a much better sign, we got a lot more spoons. And we had the money to do it. So this is one of the things that financial plan tells us, is that that's okay to do. If we think that's going to help us in the business, because we had $752 in the bank. Right? This is cash accounting. There's no loan. There's no credit here. Do that. Have your accountant do that later. But in this case, we had the money come in the bank. We still have $112.
Why did you drop the price?
I said the only way we're going to get twice as big is with a lower cost per one.
So that was a strategy to sell the amount along with the application.
Yes.
It's a whole, at that month, we decided to strategy.
And as you can see here, right, we're kind of proving in 2 months, and the third month we're trying to go get bigger. But as you can see in this storyline here, there isn't anywhere in the financial plan to make those points. Right? There's nowhere in here to put in the paragraph that says, and now we're going to grow. You have to have that somewhere else.
I'm just curious so I understand. From an operational standpoint, were you projecting that you wanted a wholesale lending provider by talking to the or were
No,
you
because I
that
didn't.
either way? Or?
We changed the price of the lemon.
Oh,
Lemons are still 25 cents a piece.
so you're just lowering the price assuming that you will get bigger on volume and that will be a benefit to you?
Yeah, well, we'll see what happens in the next month. Okay? So I say month 4 it gets to 10,000 units. Right? So how would you get to 10,000 units? Well, I'm saying nothing changes here. Right? Because now we're going to have to hire, again, back the envelope. We're going to have to hire more people to make 10,000 cups of lemonade. And so if I said it was 2,500, probably hiring 4 times the people at the same price and cost it was making. In order to make it that much bigger, I got to do 5 times as much. I could basically have to have 5 more tables, right? 5 times more signs, and a whole lot more flyers. Again, I'm just making my best guesses in this business at what I need to do there. And in this case, all right, I think this business is going to get big eventually. Right? My goal is to make this on 100,000 cup lemonade stand. But I lost $1,500 doing it that month. And I don't have that much cash. All of a sudden when I do this calculation, my cash is negative. Well, if there's one thing that you know you can't do, is have a bank account with negative cash. Right? It's not allowed. Banks don't do that. So this is the this is the way you find out how much money you need to make your business happen. You do it out, and when you have negative cash, you fix it. So, just to be clear, let's chart it out. Let's kind of see what happened here. Here's the net profit and loss, right? And it kind of dove down. And the reason it dove down is the expenses are going up on an exponential curve. And we can see right here that the cash hit 0 in month 1. Right? So one way I like to visualize this is when the cash hits negative, or it's 0, now you know you need investment to overcome it. Right? So step 5A would be, all right, well, we need some money. So let's go raise $2,000. And I put this in this line. And that then gives us a positive balance in the bank account. Now, in realistic terms, looking out at trying to operate this business, well, we know we need to raise $2,000 at the beginning of month 4 in order to pay for all this. I might try and do it in month 3, right? Expecting it to close by month 4. I may do it in month 1 with these projections with an investor saying, look, this would be a great lemonade stand. I just need $2,000 to do it. But the actual need is here.
So it looks like also the part that's not on this spreadsheet is that you hired an employee, right?
So I'm not showing the head count already.
Okay, so that's,
And there's another tab,
okay.
which is employees.
Okay. just an assumption.
Yeah. So now we can plot that out, and we can see the cash does not go negative anymore. Right? It turns around and goes positive. And all of a sudden we have this new line in here, which is how much money is running on the investment. Okay. All right, let's keep going. Now we got this business talking, and we did 12 months worth of numbers in here, all the way up to 100,000 units in month 12. And as you can see, the color thing is really nice now because we can see that we didn't change any of these numbers. They're all black. All these are different depending on what the growth is. You know, when we're needing more signs, when we're needing more students. And when we look at the bottom line numbers here, we see, okay, we raised that $2,000, we had a little loss, a little more loss. Turn the corner in month 8. But in order to eke out this number, I had to put in a loan. Right? So we did the $2,000 in fundraising. That got us through this loss, but it wasn't going to get us through this loss. I put in a 0 here. So we missed by $68. Right? Which is a pain. So we went to mom or dad, or we went to the bank, or we went to someone got a $500 loan. And the way I'm simply showing that in here is that's a positive number, says 500, and then we're going to pay it back. We're actually going to pay it back in the next 3 months. 0 interest. I went to community source capital. But it turned the corner. As soon as we got through that little $68 gap, it's now a profitable business. Right? And it keeps going. And now we've made, we got $21,000 sitting in the bank at the end of the year. Right? Not an awesome business, but if you're 10-year-old, it's great. Again, we can plot this out. It's a rather bumpy business. Right? It's not as smooth as it could be. If I were doing this for real in my actual company, I would look at why these expenses are so bumpy, and I might smooth them out. I might say, great, instead of $500 worth of signage, this month nothing, 500 nothing. I might amortize that and say, great, I got to spend $200 a month every month on signage, right? And then I'll be ahead some months, and I'll be behind some months. But the revenues are kind of good. Right, so this is a hockey stick. All right, once we're done with the first year, month by month, and we're happy with it, we need to just aggregate that up together. Right? So it's normal to have your financial plans, just to be clear, individual months for the first year and then quarters after the first year. But we have to still have sums. I just got one in email the other day, and it didn't have annual numbers in it. I just couldn't do anything with it. Right? I can't tell whether the business is good or bad. So there's a bunch of ways to do this. You can have a separate tab that has all the annuals. You can put all the annuals way off on the right. There's one trick in Excel that I like, which is this grouping. And so we can collapse the whole thing down or expand it out. It's hiding under data. So you highlight all the columns you want to group, stop one short of the ones you want to group it to, and it will make this expansion piece. And then these are just some. And I have in my own rule, which is the big sums are bold. So you can tell the total sums because they're bold. And clearly they're black because there's not going to be an assumption in this. And so how did we do for the year? Well, we sold 346,000 cups of lemonade, and we made $21,000 in the end. Okay, so we made $17,000 with a $4,000 investment, and this sums up to $21,000. So just to be clear, this is the cash at the end of the month. And you see there's another number, there's another thing underneath that. There's another one underneath it. This is a check to make sure that number came out right. So how would you calculate the cash for the year? Well, it would be the revenues or the net profit or loss plus the investments plus any loans. So it's the sum of these pieces, and all it comes out to the same number. So you know you got it right. So I often do those checks on my sums to make sure the annuals and months are perfect.
Is that the that you leave in there? final product, right?
Yeah, I'll leave it in there. You see it's smaller in gray.
Is that a common thing to do, or are they gonna be like, why do you?
I've never seen it anywhere else, but no one's gonna get confused with the same numbers there twice as fast. That's just the challenge. I have found bugs in mine and other people's spreadsheets. Yeah, that's a bad habit. Like I've seen easy bugs, like one of the rows just didn't get put in a sum, and so we had this whole section of expenses, and it just wasn't added in anywhere. Like it come in look really good on paper, and you're like when we went to execute it, expenses were a little higher than expected. I think we caught it before we got to that. All right, so moving on. Now we did year 1. Next thing to do is year 2. That would just be quarters. One thing to make sure you get right when you switch from year 1 to year 2 is that the numbers are in fact 3 times bigger than the previous month. All right, so if month 12 were 100,000 units, then quarter 1, if it's going to just be flat, it would be 300,000 units. In this business, I think it's going to be seasonal. So we go to 100,000 by the end of the year, but then we get a big drop because it's that winter. You don't buy a lot of lemonade. So this business took till second quarter to get back to that rate. It's kind of a cyclical business. I made a couple assumptions that the prices change as we get to the scale. And again, I just went through all the numbers and made sure that they were right numbers times 3. Here. And we're chugging away. We have a loss because it's a seasonal business, 2 gains and a loss. But the cash is still positive. And then a sum at the end of that one, right? The same expansion and contraction. Do it again for year 3. Right, so again, quarters. Makes it really hard to start charting. One thing to make sure you're doing is you're charting these numbers as soon as you get to year 2 and year 3. You can't suddenly chart months and quarters on the same chart. It'll look weird. And then you have to chart annual numbers. Right? Or you have to take the first year and put in quarters. Sum each 3 months to a quarter. So that everything's and so then we get the end piece here, which is the annual graph. First track through this, it doesn't look very good. Net profit and loss drops down in year 3. This was due to the fact that prices went up in year 3 in my model. And revenues were actually down. So for instance, I went up here. Year 3 and we said, well, what happens if lemons went up to 30 cents and sugar went up to 20? Well, our cost per cup was 65 cents. We're still trying to sell them at 75. Our margin specification. So what I would do in this case would be start iterating on these numbers. And I highlighted some of these iteration changes. So I started to put employees in. Let's start changing those numbers to be smaller. All right, so let's try changing those back. Go up to the cost here. And instead of, so here in year 3, instead of 65 cents, well, what if we could, at this scale, cut back on some of these other costs? We can get this down by a penny and get this down by 2 cents from the first estimate. Change the numbers around a little bit to try and make it more realistic, raise the price to 77 cents in that year, raise it up to 76. And normally you wouldn't highlight all these things in your final version, but you might highlight them in the interval version so your numbers can see them. So really, the idea is then to go back, once you have the basic model, go back and question every single number in the spreadsheet over and over again. So you should be able to sit down and go, well, in year 2, Q1, why are cups still 10 cents? Now, if I'm selling 60,000 cups, do I think I can get those cheaper? Am I justified in doing that? Go do a little research. And just keep doing that on every single one of these cells, and every number. At least 15 times, which sounds excessive. But it takes 10 or 15 times until you get the numbers to the point where you really can't imagine the revenues getting any bigger or the expenses getting any smaller. Right? Over and over again until it's polished to, perfection. And then when I did that in this particular plan, all of a sudden the graph was starting to move. Good, just flip it back, right? It was like this in the first draft. This is not a good business. And simply going through and iterating one time, all of a sudden the business is a growth business. Right? Just by looking at things like raising prices, lowering costs.
Is there like an SAT test book where it's sample businesses and all you have to do is build mini financial plans and create them? This is the most difficult thing for me to do in business.
Yeah, the only book I've found that does a decent job of explaining how to build accounting for a business is this Lemonade book, The Accounting Game. And I couldn't find any books that walk you through on how to do this from scratch or start.
I have several many people who teach it and it doesn't really work for me. I have to physically do it in order for my brain to visual, but I've never found.
Well, you can sit down and try and replicate this for another business, for a similar business. Yeah. All right, so once I was happy with this, there's one more step that I would do, which is break the assumptions out from everything else. So this is, again, step 10 spreadsheet here, and everything on one page. Some things are blue and some things are not. But instead of doing that, how about we take all the assumptions, move them out to their own tab. And in this case, you can see I still have some black things in here. They're now simply the one on the left. So the numbers that are assumptions are in blue, and everything else is just a formula that says take the guy on the left, take the number on the left. So I can change anything at any point here. I can change this to 30 cents. And then it'll all change. So anything that was in the model that would be assumptions is here, and now the P&L has almost no assumptions in it. Actually, I only did about half of it. But in the ideal state, the P&L now is just black. Or in some cases, I'll do this where the revenue tab has the revenue assumptions in it, the expense tab has the expense assumptions, and the assumptions tab has kind of the Uber global assumptions. And again, I'll have a summary tab that will just have the annuals in it. I'll have the P&L and revenue and expenses separated. If I have a business that's mostly headcount, then I'll have a separate tab or two that just talks about headcount. Right? One will be in people numbers, the other will be in dollars. Yeah, so how many people do I need? I need one CEO, I need one CMO, how many marketing people do I need? How many sales people do I need? In people. Separate from the part that says how much those people cost. And so you get this nice spreadsheet of 1, 2, 3, 4, 5 when you're hiring. And one of the common things to do in a people-based business where 90% of the expenses are people is shift when you hire people. So you sit there and do your iterations and say, well, I think I really need that second salesperson in Q3 of the second year, but according to the model, I just can't afford it, so I'm going to move it to Q4. And I could really use that developer, the software company, Q1. I can't afford it, so I'm going to move it to Q2.
Wouldn't you, like, part of like saying, if I'm going to grow my business, I would hire somebody that would need to get a loan or
Raise more capital.
yeah, it's like
Yeah, to get to balance all these pieces. But what usually happens the first time you run this through over in the tech world is, hey, suddenly I need $2 million to make this company work. Right? That's the need of cash. And you look at that and you go, well, that's hard. So, and it happens in this world with a smaller number, hopefully. How do I do it on a tenth of that?
less down.
So how on earth could I make this business happen maybe a year later, but with $200,000 instead of $2 million? Great, once you have that down, the next question is, well, how do I get it back to $200,000? Right, so what could I possibly do to make this business still happen without having to go out and raise $200,000? Because as we'll learn in an upcoming lecture, it doesn't matter how much money you need, you're going to give up the same amount of company. You're going to give up the same ownership of the company. Go the extra route. So one use of this is to multiple models that have different needs in them. When I did Ground Truth, I actually walked around with two financial models. I had one that needed $250,000 and one that needed $1.5 million. And depending on who I sat down with, I brought forth that model. So if I was sitting with an angel, I brought out the small model. I said, hey, look, you can make this business. It's a $10 million business. Just need $250,000. You need it for $100. And when I was sitting down with the VC, I said, hey, it's a great business. I think the number is about 3x the size. We just need $1.5 million.
What's your experience on Truth?
Can't quite hear you.
Oh, I'm sorry.
Raising more versus less money?
We'll talk about raising money in the future. Any questions on lemonade stands? So if you haven't done this, or you haven't done this well yet, this is really hard. But in the end, what you get is a nice, just to be clear, a nice story. Here we have a business that sells a certain number of glasses at a certain price, brings in a certain amount of money, takes a certain amount of cost of sales to do that. Here are all the expenses to make that happen. Right? Here's the total number of investment dollars we need to do. And in the end of the day, here's how much cash return. That's what I mean by story. Top to bottom, no gaps. Easy to describe.
Hypothetical, but I'm wondering, we were talking about how your product is seasonal, the lemonade. I was just wondering, from like a business standpoint, like, oh, during winter, you would make on site, so in the summer, you would. But would you just, from your standpoint, frame that as like, oh, that's a totally different business, it's a different product, or that is smart information around issues based on assuming cost is the same for site as lemonade?
Yeah, so I would do, I think in that case, if that were my business, I would have a spreadsheet for lemonade and a spreadsheet for cider as units, because they're going to have different cost of goods and all that. And they may have different, the one I skipped over here is kind of the number of people needed to go and make these things up. I would go down to that level of detail to say, per hour, what was it really going to cost per hour? And I would have those two units, and then in this main P&L, I would have a row for lemonade and a row for cider. So they're probably going to overlap some part of the year. And just draw in the cost of goods from that other spreadsheet. So I wouldn't show it in this P&L. Yeah, lots of rows. Rows are good. And to make it readable, I would take the cost of goods and just call it cost of goods, and just have it draw from those spreadsheets, and cost of goods from lemonade and cost of goods from cider, and add them together and just show cost of goods. And that way, when I'm telling my story of what it takes to make that lemonade, I would do it in the lemonade tab, and when I'm in this P&L tab on how much money we're going to make, we're just talking about cost of goods. They already know what that is. And if it's totally not clear, just this is one column per month or per quarter per year. You can go out for the 3 years. Right? You can go down. I've seen models where it was really important they did it by week. That they were a very cash flow oriented business, and they had to make sure the cash flow per week. So they did a 52 column model per month, and then they did months per year too, and then they did quarters per year. They needed to get down to the granular. Okay, anything else? So the question was, how fictional are they? Almost no startup actually makes as much revenue as they think, even when they say this is low, conservative low. Many second-time entrepreneurs can hit the expense number. First-time entrepreneurs, it's still a stretch too. So it's usually off. It's usually the revenues come in much later than you think, and something costs more than you think. But it's still a good starting spot. It's way better than having nothing. Yeah, you should do a expected model, a low model, and a high model. And, and you should just know the low is going to happen. It's likely to happen. When you operate your business, that's kind of a different question. What do you do with this once you're operating your business? Is you kind of use this as your scorecard to say, where am I? Right? So take off, erase erase all the names up here. Right? So, right? Oh, and by the way, I always do month 1, month 2, month 3, as opposed to saying we're starting in November and therefore the first column is November. Because what happens is it always takes longer to start. You have to change that. So it's just month 1 through month 12. When you're up and running with the account, to turn this into actual annual account. But if you erase that top line, you know you're in there somewhere. So in this case, if we were operating this business and we sold 20,000 units this month, and who knows, it might be 14 months into the business, but we can then go back here and say, okay, in the month where we were supposed to sell 20, we're actually here in the model. So we better not expend more than what's down there on expenses. Right? And keep resetting where you are. So you may actually sit in month 1 for 3 or 4 or 5 or 6 months trying to get up and running. And then you're actually going to get up. So this tells you not to overspend your expenses.